Morning, Wealth Press subscribers and viewers. Welcome to another it's a Tuesday morning roundtable this week. My guests today are Roger Scott, Jeff Yasteen, and Adam Serhan. Welcome, gentlemen.
Thank you for having us.
All right, let's start with you, Jeff. What's going on in the markets this week?
Well, I think the story the more telling this week is the same story it's been telling pretty much since the bottom in March, but especially the last handful of weeks where it's just on autopilot, in my view. I mean, it doesn't really matter what is happening out there, what the news is, one way or the other. Anything that's remotely a dip gets bought. And, it's just one of those periods where you just have to be patient, because you can see there are distribution days going on for some of the big, tech leading stocks, in my view. But when they get sold, there's plenty of, let's just say, Robinhood traders and others who will come in and buy them, and they move higher. And of course, they do have a good narrative, the comeback narrative, if you will, that is sort of putting the story behind them. And as we all know, that works until it doesn't work. And it works right now.
Exactly. Adam, to what extent would you say that this is a byproduct of all of the stimulus that central banks have pumped into the system?
To what extent? I'd say about 150%, if that's a possible number. I mean, there was a article yesterday that was circling around. Somebody sent it over to me. It's called "Shadow Banking: The War Between Central Banks and What's Not Being Said." So when you have a situation where the Fed and every other major central bank in the world, in a coordinated effort, is injecting trillions of dollars into the system to save markets and the economy, both Main Street and Wall Street, you have the byproduct of stocks are going higher. It's like the game of musical chairs we spoke about before. It doesn't last forever. Eventually, the patient can't take it anymore, and then you get that big dip or that big, bear market or pullback, recession, whatever word you want to use, that lasts for longer than 2 weeks, like we saw in March. So for now, there's no question, you don't want to fight the Fed, like Marty Zweig, a famous investor, once said, and you also don't want to fight the tape. That's my line. And the tape is just another word of saying the market. So in this case, the trend is clearly up, and pullbacks are to be bought until you see any kind of weakness show up that's sustainable. To Jeff's point, it's a situation where weakness is being bought, not sold. The Dow's sitting right in a quiet area above the 50-day moving average. The S&P is acting well. And you're seeing other breakouts. Look at a stock like Costco today breaking out. And you have a lot of other setups as well. Lululemon, Shopify, so on and so forth. So we're seeing the tale of two tapes, more of the same. The big money's focused on those tech stocks. The stay-at-home stocks are doing extremely well. But we are overdue for a pullback to consolidate this move.
Sure. Now, Roger, here's the great consolidating question, and I hope I don't make a dog's breakfast of it. Do you think that this global central bank stimulus on a coordinated basis constitutes essentially global hyperinflation of currencies for the first time in history? And is this, in fact, a lit fuse that is going to blow up the entire financial system when the inevitable mathematics catches up to the hyperinflationary phase that we've entered? And are these stocks performing at just, vertical slopes? Is that a byproduct, or rather a symptom, of global hyperinflation in the form of central bank stimulus?
It's a great question, but it's a multifaceted question. So let me take it apart. Okay. First of all, I think with the US dollar declining, if what you are proposing or suggesting is happening, I think the US dollar would be more reactive to that. I think the fact that the US dollar is not reactive to that, and I think the fact that money is shifting between gold and the bond market right now is quite indicative of the fact that that is not happening yet. I think that gold would react much, much more, and interest rates would be a lot more sensitive to that. I think it will happen, but I don't think it's happening just yet. I don't think it's happening just yet. I don't think the world is ready for it right now, especially with this influx of capital coming into the economy. I think there would be a much greater impact on the US dollar if that was the case.
Sure. You say, though, you qualify that with yet.
Yes. So, absolutely. Oh, it's inevitable. It's going to happen. There's no question about it. But I don't think we are there yet. I don't think we are there in a political sense. I don't think we are there. I think if that was the case, we would have seen it already in February.
Right.
And the fact that we haven't seen it, and the fact that the market's been so resilient since then, obviously thanks to central banks and the Fed, I think that we are kind of pushing all of that under the rug. But you and I have talked about this many, many, many times. There's only so much you could push under the rug before that rug starts getting very, so it's a matter of time. I mean, look at the deficit. I mean, the numbers are just increased. It's like nobody's even looking at it anymore. It's like they completely put their head under the sand. I mean,
Right.
Just during this fiasco, during the last 6 months, we've seen the deficit increase, by 27%? I mean, it's mind-numbing. It's
Right.
mind-numbing. But again, we are not, you see, I think for us to be able to evaluate the market from a value perspective, which is what you're doing right now in a macro scheme, I think the market has to be set up for that. I think we have to, I think we have to go back to value. And right now we're in a momentum stage of the market. This is why, and again, nothing to, it's just the way you're thinking is very similar to the way Warren Buffett thinks. And Warren Buffett has been missing. I mean, hey, that's, it's not the worst thing in the world to think like Warren Buffett, right? I mean, Warren Buffett, but Warren Buffett is a value investor. And right now the world is completely driven. The market sentiment is being completely driven by momentum. In order for us to think of the market from a value perspective, we have to have a major wake-up call, and we're just not there yet. Especially not.
Go ahead. I'm sorry. I didn't mean to step in on you there, but I agree with you 100%. And in fact, when you talk about Buffett, look at his latest purchase, his only purchase that we know about, of buying, what is another 10 billion or 11 billion, whatever it is, of Bank of America. And it's sort of like, why is he doing that? It looks like it's dead money, but clearly, he believes not just in the stock, but I think he believes that with all this money flooding the markets, there is going to be something different coming out on the other side, which, we would think is some sort of inflation compared to what we have now, which has been, a lack of it.
And at the same time, I understand he's accumulating Apple computers as well, or starting to accumulate Apple computers, which, so he is starting to shift. I think he's been hanging out with Bill Gates a bit too much, if you ask. But I mean, he still has a huge percentage of Wells Fargo. That's a dog. I mean, that is that. So well, in a value type of a economy, a very different economy that we are in right now. And I don't want to get political, but while Trump is in the White House, we're going to have a momentum type of market environment. It's all about what's coming up ahead and all the goodies that are ahead of us. But also keep something else in mind, and we have to kind of look at this too. We have a lot of catalysts that are coming up right now that are new. For example, 5G. That's a brand new catalyst. We haven't seen a catalyst like that in over a decade. Self-driving cars. There is a lot of technological catalysts on the horizon that are a brand new technology that we haven't seen. That's going to really change the shape of how the world works. And I mean, artificial intelligence, robotics. I was doing a report on a company that's making robots see. I mean, it's unreal. I mean, robots, I mean, this is Terminator, things that, Buck Rogers, if you're old enough to remember that. So, the world is changing, and I don't think the world is focused right now or being driven by value. I think it's being driven by momentum until it gets back to reality, which may not be for quite some time. I think we're going to see very little common sense in terms of inflationary value, at least till the US dollar starts inputting that into its sensitivity, and that hasn't happened yet. But I did want to, just very, very quickly, I did want to interject on something that you guys have been saying. The stock market is bullish, but if you look at the number of stocks, right, and I was doing this morning, that are trading above the 200-day moving average in the S&P 500, it's 52%. So the stock market externally looks very, very bullish. And yes, we're seeing, the QQQ the electric car, the robots, the cloud sector, the REITs that are non-commercial real estate, they're making 52-week highs right now. But at the same time, if you look at the broad market, it doesn't look nearly as healthy as it looks externally when you look at it internally. I mean, 230 stocks, 210 stocks out of 500 are bearish right now in a broad market. That's not a really, healthy market. So just something to think about.
Okay, so I mean, it's interesting. The prevailing wisdom suggests from all of you guys that don't fight the Fed, don't fight the tape, get in there, get a glove, get in the game while the getting's good. Yet we all acknowledge that this is a precursor to something out there on the horizon that we don't know how to really think about it, because the possibilities are endless. Does it result in a global special drawing right administered by the IMF and really controlled by the G7, or does something else come out of this? Fine, but to me, I mean, I'm looking at gold more now as like, normally I consider gold to be 15% allocation of my portfolio. I'm thinking of taking that up to more like 35, 40%, because I believe that there is an inevitability of, there's some kind of mayhem out there. And whether it's if it's the historically typical hyperinflationary outcome, then buying the Bank of America might be more indicative of senility than it is strategy in Warren Buffett. And I say that with the utmost respect for Mr. Buffett, and I say that tongue in cheek because, there's no denying his track record. It's, unassailable. However, there's not a single one of us who are immune to the effects of age. And sometimes if you've spent your whole life in one sort of way of thinking and acting, there does come a time where the universe changes slightly, and that is no longer going to succeed. So to what extent, I'm going to lay this one on you, Adam, to what extent do you think Warren Buffett's right buying Bank of America versus I've never heard Warren Buffett really be that bullish about acquiring gold?
Sure. So that's a very good question. I think Buffett is spot on with his analysis for what he does. It's really important as an investor or a trader is to stay in your lane. And there are going to be periods, it doesn't matter what your strategy is, where your strategy is in favor, and there's periods where your strategy is out of favor. To Roger's excellent point, right now, his strategy is out of favor. That doesn't mean that you should give up on it and they call it style drift, where you jump from one style to another style to another style. It's okay for him to buy more of Bank of America. Now, should he be buying gold? That's a different argument for a different conversation, depending on his investment thesis and what's appropriate for his portfolio. But to Roger's point and to Jeff's point, the market is a very momentum-driven market. But under the surface, if you do some digging, you do find a lot of value that is setting up that has been beaten down. There's 200 and some odd stocks, as Roger had mentioned, that are trading below the 200-day moving average. The 200-day moving average is just a really long-term indicator that shows you, more or less a broader trend. And if the stocks are trading below there, that means they're beat up. Now, does that mean they're left for dead? No. Does that mean they could turn around and blast off at some point? Absolutely. We have a vaccine for the COVID situation, and you could see a lot of these stocks that are extremely undervalued take off and go to the moon. Airline, transportation, so on and so forth, or hospitality stocks, the hotels, et cetera, et cetera. So if you're able to understand that value has a piece, just like gold has a piece, and just like growth and momentum have a piece in your portfolio, and you're able to allocate accordingly, you can do extremely well. And then the other point with gold, most people look at gold as a commodity. I look at it also as a currency. Because if you look at the global currencies, yes, there's lots of different currencies. And to, again, Roger's point about the dollar, there's no question. If and when we enter that hyper phase of inflation or whatever ends up happening with the ramifications of all this easy money being pumped into the system, you're going to see a flight to quality. Gold is already trading at or very near all-time highs. Silver is even more undervalued, hasn't gotten there. But if you look at the other metal complex, you can look at platinum and palladium and so on and so forth. They've got huge moves ahead of them as well, if that all unfolds in the way that everyone expects it to. So there's two kinds of landings. They call it a hard landing or a soft landing. And that is the trillion-dollar question. Nobody knows what's going to happen at the end of this massive global experiment with all these central banks infusing gobs and gobs of money into the system. time will tell, but we do know what's happening right now. So what I always tell people is make decisions on what's in front of you right now and prepare for the outcomes of what may unfold down the road.
Okay, so our conversation today is really centered on value, and it's interesting that Warren Buffett enters the conversation. And Adam, you talk about value and the undervalued status of a great percentage of the market. My question is that relative value you're talking about relative to the high-flying FANG plus stocks that they're undervalued? Or are you talking about more fundamental value based on their earnings and the multiples associated with that in their share price?
Both. Yes.
Oh,
How about that as an answer?
okay.
So
I was afraid of that.
that's it. So if you want to understand value, like you said, there's two real big ways of looking at value. It's relative to everything else, and sure, they're undervalued. And the other way is just looking at it based on the sector and the stock specifically. Is it undervalued based on the metrics that the stock and the company exhibit? So if you've got a great stock that's trading at a depressed or a low multiple, which is just a multiple of the earnings, then that could be considered an undervalued stock. Now, a lot of value investors like to buy stocks that have just been forgotten or just are overlooked. It's like a blind spot. You know, when you drive in a car, you have a blind spot right to both sides of you. You just can't see out the mirror. Doesn't mean that it's not there. It's just you physically can't see it for that split second until you pass it. And okay, you look over your shoulder, you see it. So in the market, I call there's the value blind spots. People just don't see them. Right. So you look at biotech stocks have been left for dead since 2015. They had a big turnaround in the last 12 months or so, but a lot of biotech stocks are still extremely undervalued. I mean, there's one that's really cheap. There's Zosana Pharmaceuticals, ZSAN. It's $1 stock. They're trying to cure headaches for all intents and purposes. No revenue, no earnings. So put the disclosure out there. It's a speculative. Their drug is in some kind of it's in the trial and all that FDA approval. So they've got things they're working on, but you've got $1 stock that they're working on fixing headaches and migraines. Imagine that hits. What's going to happen? So, and the stocks already had a good volume and good pattern and institutional, some buying up there, all that kind of fun stuff. And then that's just one. But look at the airlines. Look at American Airlines. Look at Delta. Look at all these. What happens when we get a vaccine? I'm trying to be positive here. I always like to say we're one headline away from a vaccine and life going back to normal. And then what's going to happen to all these stocks? You're going to see them just as fast as they fell. They're going to go right back up. Look at the cruise lines, Royal Caribbean, Norwegian Cruise. These stocks are trading extremely cheap. I mean, they were 3, 4, 5 times the price just earlier this year. So if they just go up half that amount, you're going to make a killing.
Right. Okay. Sorry, just Adam, what was the symbol of the company that's curing headaches? That's just intriguing to me for tangential reasons.
Sure. ZSAN. So that's Zebra, Sam, Adam, Nancy. Full disclosure, one of my companies has a position in it. So putting that out there. But they're working on curing headaches and migraines.
Okay. Interesting. All right. Let's start to bind these threads together. Now, what does this all mean for our retail this week? How should they be facing the market? How should they be thinking about deploying capital? How should they be thinking about protecting wealth? And let's start with you, Jeff.
If we're talking short term, let's say just speculating on the broader direction of those stocks that are moving higher, fine. Stay with your call options on the most liquid names, betting that we get at least a few more weeks. Possibly, I see this thing going possibly into Labor Day. When we think about the top in 2000, the NASDAQ fell hard, rallied through the summer, and basically rallied straight up through Labor Day weekend. And then it was suddenly like, as if that Tuesday, everybody came back to work on Wall Street and said, oh, let's start selling, the .coms again. And that was when the real downside began. So, we can't discount those sorts of weird seasonal possibilities. But short term, stay with what works. Longer term, like Adam and Roger would say, there are so many great stocks out there that are just laying there waiting for somebody to buy them. The only risk to owning them now is, yes, they could become even more undervalued. And quite often at the end of a trend like we're seeing here, if it's actually ending in the next month and a half or so, that's often where the worst short-term declines are. And so that's what you have to sort of sit through. That's the risk in getting your timing wrong. And that's just something you have to develop a stronger stomach on. So look for those ones like Adam was saying, Carnival, Royal Caribbean. I like a Legion Air, Southwest Air, Hyatt. Was it Wyndham? I mean, there's all sorts of stocks that have just kind of been laying there, left for dead because they're not COVID plays or the opposite of what a COVID play is. And those are the ones you want to buy. You just got to think about what the world's going to be like a year and 2 years and 3 years from now, and not what it's going to be like over the next 4 to 6 weeks.
Interesting. So that's the first call I've heard where it's time to wade in and buy the beat up airlines travel related stocks. Adam, do you share that viewpoint, or do you have something else you'd like to sort of focus on for investors this week?
Yeah, I think Jeff's spot on. My focus this week are earnings. We've got a few hundred companies reporting earnings. You've got companies like Wayfair, CVS, Square, so on and so forth. And these are big names. So I want to see A, what the numbers are, but B, more importantly, how the stocks and the market react to the numbers. The fact that the market hasn't fallen over the last several weeks and months, and you've had hundreds of reasons to fall, whether it's a spike in corona cases or the GDP miss or it speaks volumes to what big institutional investors are actually doing with their money. So for now, I think for the next week, to answer your question, I want to see these earnings, see how the market reacts to the earnings and how the stocks react to the earnings, and then go from there.
Okay, and Roger?
I'm taking a slightly different route. First of all, based on the last 50 years, every time gold has rallied, silver has lagged behind the rally, but has ended the rally on a higher note. In other words, there's more upside in silver than gold. So I'm beginning to accumulate stocks that are related to silver mining. I'm becoming big on silver mining ETFs and big on silver. So I'm starting to focus on silver because I think silver is going to follow and then supersede gold in terms of the move. And it's happened every time in the last 50 years. Number two, because earnings are here, I still want to get the upside from the momentum stocks, but I don't want the risk. So instead of staying in the hottest stocks, I'm now moving into the hottest ETFs. I'm looking at ETFs that are in the, can I give you a couple of things that I'm looking at?
Yeah, absolutely.
Well, I'm looking at Alexandra Real Estate Equities. They are REIT that rent space to laboratories that are looking at COVID-19 cures right now, like Bristol Myers, Celgene, Amgen. So they only rent to laboratories. And with the amount of money going into federal research for COVID-19 studies and the seriousness that we're taking these research companies in, I believe they are going to be very, very hot for the next several years. Another ETF that I really like right now is CARS, K-A-R-S. It's a electric car ETF. Another one, iCloud. It's a cloud ETF. So all the stocks that I'm looking at that I've been really bullish on, the cloud stocks in the last several months, they're in there. So generally, I'm taking money from the individual stocks and putting them into ETFs because of the volatility that we're having with earnings. If earnings mattered a lot more than they usually would, if earnings were the driver, and they usually are, but right now COVID is the driver. But if earnings were the driver, then I would probably become more defensive. But because COVID is the driver, we're still seeing the upside in the stay-at-home stocks. So I kind of want to have my cake and eat it too. So instead of getting out of that exposure, I'm merely diversifying it to get less volatility. But I'm kind of trying to get to have my cake and eat it too, and increasing my exposure in silver instead of gold. A lot of people are looking at gold. I am looking at gold. I think everything we've been saying about gold is 100% on the money, but I think silver is the hidden gem there, so to speak.
Sure. Lots would agree with you there. All right, gentlemen, we're going to leave it there for now. That's an excellent roundtable as usual. I wish you all the very best this week. I look forward to talking to each of you throughout the week, and I'll see you next week for the roundtable.